Hey everyone, it is showtime. We are here with Dave Hall doing our Q&A. Dave, we're both in weird new places today.
Yes, we are. I am in Las Vegas and you're at home.
Yeah, and I do have my pants on just to let you know because it seems like all the Zoom videos or Facebook videos we watch, somebody's dressed up with no pants below. So I do have pants on just to let you know.
Good, good. I'm glad to hear that. I was joking the other day, I was doing a webinar and my webcam wasn't working. So I couldn't do the webcam, which I usually do. And I just joked with everyone that I was still in my pajamas, that's why I didn't turn the camera on.
Yeah, so we're both in new places today, but the show must go on, and so we're both here just doing our thing. And so you're in Las Vegas today, is that right?
I am, yes. I've got a number of clients I've got to see here in Vegas. I've been here since Sunday. I fly back home tomorrow, but I've had a good time just hanging out with people and getting a chance to go through issues that they have as they prepare themselves and their business for the future.
That's awesome. And I'm about a whole 2 minutes from the office at home, so I've traveled really far myself.
Yeah, did you do that in snow uphill both ways to get there?
Yeah, and 19 degrees, you bet. I worked pretty hard to get here.
Yeah, my kids always joke with me on my commute up to work because I go up the stairs from our kitchen after we have breakfast and spend time together as a family, and the kids go off to school. I have to go up the stairs to go to work. And so everybody gives me a bad time about my commute, making sure I don't have any issues.
Now, you do have something very cool upstairs in your office that you entice your kids to come visit you. Now, tell me about that.
Yes, I do, because I am in a home where I'm upstairs. Most of what goes on is downstairs, generally in the home, and ours is that way. The bedrooms for the kids are upstairs, so unless they're sleeping, they're not up there that much. But I put vending machines upstairs. So there's a bottle of money that they can get access to. So when they want candy or treats, they've got to come and see their dad.
That's awesome. I need to have one of those just so I can give myself treats, I guess.
Yeah, I will admit I get my own treats out of there as well, but it is nice because usually at least one time during the day, they'll show up for their treats and we'll get a chance to talk for a few minutes.
That's good. I like that. Well, for those joining us live, we come and ask Dave all the retirement questions. We talk about Medicare, reverse mortgages, Social Security. We just throw a ton of questions at Dave, and Dave is so gracious to sit and answer all of these questions. And so for you joining live, let us know where you're coming from, and also submit your questions. And so if we have time, we'll jump on and do some audience questions. And so what I do is I have a list of questions that I ask Dave, put him on the spot, and then he goes through and answers those. And then for the rest of you, please feel free to, like I said, to submit your questions. Now, if you're watching on replay, please go ahead and submit your questions to us at theprosperityguy.com, and we'll add that into our next week's show. But Dave, are you ready to get started this morning?
Yes, let's get going.
Okay, I know the times are a little different for you, but we're so excited that you're able here to join with us. And before we get going, one of my favorites that joined the show, we've got Karen. Karen's here from North Carolina. Hi, Karen.
Hello, Karen. Good to have her with us again today.
Yeah, always great to see those joining us and returning and listening as we go through this. So, okay, Dave, well, let's get the show started. I have Carol Ann, and she asked, if you already have long-term care insurance that is paid for, should you still get a life insurance retirement plan?
This is a great question, Carol Ann. And for those of you that have not been to my webinars or maybe have not heard us talk about the life insurance retirement plan, one of the big risks that it solves is long-term care. Many people want to use the plan because if set up correctly, they'll be able to take their death benefit, be able to pay for a long-term care event, not having to spend down all the other money that they have set aside for their retirement. But when we look at it, it's not the only risk that we are reducing in retirement by using this product. One of the other risks that it reduces and eliminates is tax rate risk. We're in a situation where we don't know what tax rates are going to be in the future. And if you look at the spending of the United States right now, everyone's got to believe that taxes are going to have to go up. There's no way we're going to pay for the debts that we have if we don't have more money coming in. And the only way the government has to make money is through taxes. So as you look at it, don't just throw it out because it is not solving your long-term care need. If you've got tax rate risk issues, if you've got sequence of return risk issues, still may be something that you will want to consider for your own retirement based upon your own facts and circumstances.
And Dave, for those who are asking, that are watching live, asking to themselves, life insurance retirement plan. Tell me about that, because I know that's something we've talked about many times on the show and on your podcast and webinars. But for those tuning in live, tell us a little bit about what we're looking for with this life insurance retirement plan.
Yeah, the biggest thing we need to realize is it's a lot like any personal relationship, especially if you look at it in a spousal relationship or someone you're expecting to spend your life with. There are a lot of qualities that you want that person to have. You're not going to just go out on the street, pick someone and say, look, we're going to spend the rest of our lives together. It generally doesn't turn out so well. Same thing with these life insurance retirement plans. What they are is a life insurance policy, but they're structured with all the benefits needed to allow you to get to a safe and secure retirement, to do what it's intended to do. And that's the one thing you need to understand with insurance. It can be used for a lot of different things. It can be used to transfer assets for an estate to where you don't have taxes. It can be used for a death benefit, but it can also be used to eliminate risk during retirement. So what we do is we put a plan together that fits the requirements, very much like your marriage, where you're getting with a partner that you expect to be able to enjoy your life together. We want to put that together so you can use it throughout your retirement and then have it do the things you expect it to do when those times come in your life that you need the policy to start acting for you.
Awesome. Well, Dave, thank you so much for explaining that. And for those, again, joining us live, we're so glad you're here. Thank you for joining us. We also have Jeff on, Dave. So Jeff's jumping on to say hello. And I believe he's from Florida. Sounds like he's having some rough weather there.
Yeah, Jeff, welcome. Jeff has been doing all kinds of education lately. I'm not sure what it is, but that guy, every time I see any posts from him, he has just got a new certificate and a new qualification that he's done. So congratulations, Jeff, on all you're doing with the education courses you're taking.
That's awesome. Well, Dave, again, we appreciate you coming on and answering all the questions we have, and especially we talk about particular topics as we get into retirement. I do want to jump into our next question. This one comes from Laura, and she says, does a large age difference of 10 years or more create any problems with your planning?
Yeah, so when we look at our overall planning, the whole goal is to eliminate risk and to eliminate taxes during your retirement. So if you look at it from her question standpoint, don't think that there's this overly complex system. Now, retirement planning is complex, so there's all kinds of moving parts, there's all kinds of tools that you need to have. But as you look at it, when you have age gaps, there's a lot of risks that pop up, because now not only are you having to prepare for your life expectancy, but you're having to prepare for that younger spouse. And not always, but often it's an older male who doesn't have as long of a life expectancy anyway. And you've got a younger female who's expected to live longer just by the nature of being a female. So here you've got this situation that, unfortunately, what I see is too many men prepare for their retirement and then stick their surviving spouse with a situation that doesn't look anything like the retirement they were living prior to their passing. So as we look at, if you're a younger spouse, it's just more important that you're planning for that younger spouse's age, that you're not just planning for that older spouse. You're saying, look, what do I need to have in place so these assets will last until I get through retirement?
I'm glad Laura sent this question in, because you're right. We do see a lot of questions that come in asking or addressing this particular topic here. And that's one of the things that you really clearly stated, is that when we get older, we're basically planning for our retirement, but then we still have to remember there's people behind us that are still going to receive benefits. So I'm really glad you brought that up.
Yeah, I really want to write a book. I'm not sure that's going to happen. Now, I've got multiple books. I've got one that will be coming out sooner than this one, but called Husbands Love Your Wives and Plan for Their Retirement, because that's not happening. And you see many people talk about it out there in the financial world. You see many people address it saying, look, we're just not preparing for that younger spouse that's generally a female and making sure that they're having the retirement that they need. And I've seen it many times with clients. They many times that male, and I realize I'm talking specifics here and generalities, but what you have is many times you've got a male that's going to plan for their retirement. They're usually, many times, the more proactive one in regards to the economics of the relationship, and it just leaves some bad situations. Now, realize that's not the case for everyone, and I'm not trying to say that your situation is going to match that, but there is a large segment of the population that really needs to start planning differently.
And Dave, let's take Laura, for example. Let's say that she has a husband named Bill that's older, and maybe he's to retirement age. Now, if he's going to go to this point and say, okay, I'm ready to retire, what advice do you give at that point to help make sure that Laura and Bill are working this out together?
Yeah, communications is key. You've really got to make those decisions together. The problem with retirement planning is oftentimes you can make the decision yourself. Social Security, for example, that's an individual retirement plan, meaning you can make all the decisions for your Social Security without anybody else being involved in that decision. You don't have to include your spouse. So you've got maybe a husband that's worked their whole career and they're saying, look, I'm tired. I want to get every dollar I can from the federal government. So I'm going to claim at 62 when I can start getting that money. I'm going to be able to get it throughout the rest of my life. Well, because of delayed credits and because of discounts that occur if you take benefits prior to full retirement age, what you're doing is you're hurting not only yourself because of life expectancy for many, but you've definitely hurt that younger spouse because she can get benefits off of that money. Someone like Laura could get benefits for the rest of their life. So now all of a sudden you've got this huge life expectancy. And because a husband, Bill, decided that he wanted to claim early, it really did a number on their whole overall retirement plan.
Great. Thank you, Dave. And Laura, thank you so much for that question. And again, if you're watching live, please go ahead and submit your retirement questions. And if we get to, we'll slide them in with the series of questions that we already have here for Dave. Dave, let's jump to the next one here. And Anna will ask, what rate of return can be expected from an LIRP, which is the life insurance retirement plan?
Yeah, this is a big issue that needs to be talked about. This is a great question that people need to understand what's going on in their life insurance retirement plans. When these things are put together, when you're putting an insurance policy together that's invested in the market in some form, whether it's an indexed universal life policy, variable universal life policy, even a whole life policy, they're going to give you a rate of return that you're expected to get out of that policy. And then they're going to illustrate it out and say, this is what your plan's going to look like. Back when I bought my first permanent life insurance policy back around probably 1999, it was right before the dot-com crash. So it was during the dot-com boom. I bought a policy. Well, at that time, some of the small cap stocks were over 100% return on an annual basis. Mm-hmm. So they illustrated that policy at 12%. It was before I ever got into the industry. But the guy who sold it to me illustrated 12%. Well, based upon that time period, that made sense. Well, then everything crashes, the market goes off the table. 12% was not even an option. If you look at it now, saying there's no way you could take a life insurance illustration over a 30-year period of time at 12% and have it work out. So I ended up losing that policy because it was illustrated incorrectly. The premiums that were scheduled to be paid were never going to be enough to keep it going. So as you look at this, Anil, from a life insurance retirement plan, what we're finding is it's somewhere between 6.5%, maybe 6.75%. Those numbers have gone down based upon current interest rates. We've got historically low interest rates. You're going to be somewhere in that market. My recommendation is, to get an exact number, you're going to want to be able to sit down with an advisor who can walk you through that number where it is, on a daily basis and based upon historical facts and what the future looks like. What can we get out of these? Because you want to be able to make sure you're getting that rate of return going forward throughout the rest of the time you have that policy.
Great. Well, Dave, I'm going to try to breeze through a couple more here so we don't get stuck too far back. But my next question is from Michelle, and she says, if you are covered by a younger spouse's employer plan, can you delay enrollment for Medicare without penalty?
Yes, when you look at Medicare, be aware there are 4 different parts. You've got Part A, B, C, and D. Part A, once you reach age 65, if you've got the work credits that you need, you can get that without penalty, without cost. You can take those benefits. Part B, if you do not get into the enrollment periods that they have available for you, you're going to end up with a 10% penalty for the rest of your life per year for every year that you wait. So if you decide to wait 3 years beyond when you could have enrolled, you're going to have a 30% penalty on your premiums for every year going there forward. When you look at it here, if you've got a employer provided insurance plan, then no, Michelle, you're not going to be penalized as long as you have that group plan that's provided by the employer of your spouse. You would be able to delay getting into Medicare, and then once that disappears, you have an 8-month window to where you have a special enrollment period that you can then go sign up for Part B without any penalties.
And Dave, since we're talking about Medicare, tell me a little bit about maybe some of the ins and outs, maybe some things I should look for if I'm looking into Medicare or I'm getting closer, because I feel like there's a lot of people that aren't understanding Medicare the way it really should be looked at.
Yeah, great question, CR. And the biggest thing people have got to look at on the Medicare side is it's not the end all be all. Many people think, oh, it's government insurance. It's going to cover everything. Once I sign up for Medicare, all my medical issues are behind me. I never have to worry about it again. They're going to cover everything. I'll have small copays. There are so many gaps in Medicare. Gaps from Part A, where if you've got hospitalization, you're going to have gaps where you may be stuck paying tens of thousands of dollars, maybe even $100,000 plus, because of the gaps. If you have Part B, you're going to have tens of thousands of dollars of payments, because on Part B, they only cover 80-20 and there's no limit. So that 20% could go up to hundreds of thousands of dollars. So the biggest thing I recommend is to make sure you understand the Medigap plans or Medicare Advantage plans, whatever you choose to get. You could use either one of those to help make sure you're covering the gaps that exist in your situation and how much you want to have those covered. And there's different options. You have a lot of options to choose from. You want to look at what the gaps are and then try to figure out how to close those gaps.
Great. Well, Dave, since we're talking about Medicare, I put a couple more Medicare questions in here. And again, I put in the chats there. If you have any questions about retirement, please go ahead and submit those. Dave, my next one comes from Donna. And she says, can you claim Medicare for yourself based upon a younger spouse's work record if they are in their 50s?
Donna, you cannot. You've got to wait until they reach age 65. So that's the age they've got to be able to be at that age. Until then, you're not going to be able to claim. And this is a problem that many people have because they've got gaps. And the other thing you need to understand too is if the older spouse gets 65, the younger spouse also is not going to be able to claim until they get 65. So you've got to look at those pre-Medicare gaps also between what you had from an employer maybe provided plan or a personal plan and once you can get on the Medicare insurance that the government offers.
Dave, it seems like we're getting a lot of questions at that kind of that gap right before retirement, where a lot of people are maybe in their late 50s, early 60s, and they're all kind of in this limbo right now where they're saying, what do we do for Medicare, for Social Security, for all of our retirement? And it feels like we're getting a lot of questions kind of regarding this little gap area.
Yeah, I think it's because if we look back in history, that we've pretty much been told that retirement age is between 62 and 65. I think if you look back on, if you were to go do a survey, and I've not done this, but I believe based upon what I've learned going through the process of educating people, that if you were to put out there, what should be the appropriate retirement age, 65 is probably going to be on the max end for most people. Well, the problem is Social Security for your full benefits doesn't kick in till somewhere between 66 and 67. So as they start educating themselves, if we're in our 30s or 40s, it's like, oh, I'm going to retire at 65. Well, then as you get 60, maybe 59, 60, you start educating yourself and you're like, wait a second. You know, if I wait on my Social Security until I get full retirement age or even till age 70, I can get way more benefits. So then all these questions start popping up. How is this going to play in? And again, if you were thinking at Social Security, early Social Security age at 62, well, now Medicare doesn't kick in until 65. So I think it's just a lot of misconceptions from when we're younger that as we age, we start finding the solutions to, and they're not, or the answers to, and it's not necessarily the answer we want to have.
Exactly. Well, David, again, I've got a few more Medicare questions I want to throw at you here before we get done. The next one I have is from Prabha, and they ask, are the monthly Medicare premiums per person or per couple?
No problem. They are per person. So when you look at it, the current amount right now, I think is $134.60 for Part B for 2020. These numbers change all the time. They're always increasing based upon inflation. So it's going to go up year after year. But if you look at these numbers, they are per person. And Medicare is a per person policy. Now, if you have work credit sufficient to qualify for your own benefits, your spouse can get benefits off that work record, but they're going to have to set up their own account. They're going to have to pay their own premiums. All these things are going to have to be done on an individual basis.
And Dave, I wanted to take a quick break from Medicare. This is not to add a sponsor in or anything like that. It feels like I'm taking a commercial break. But I've got Karen jumping on through Facebook. So we have Facebook and YouTube Live going right now. And Karen asked a question about Social Security. And she says, if you start collecting Social Security benefits at age 62 and continue working, will my Social Security benefits increase due to my current earnings?
Karen, a couple of things that I want to answer for you here. I think there's a couple of things you need to look at. One, yes, they will increase, but you may also lose those benefits. Meaning if you have earnings over $18,240 during that year, for every $2 you earn over that amount, they're going to reduce your benefits by $1 for the period of time that you're working. So if you're age 62 and you make $28,240, $10,000 over, your benefits will be reduced by $5,000. So it's all going to be delayed. I mean, you'll be able to get those back at a future time. But what we find is many people think they can start claiming those benefits early and match it with their income that they're getting from their job. And they then get to a point they say, oh, wait a second, my income's so high, it phased out all my benefits. There was no reason I should have even claimed at this point. I should have just waited until I was done working.
Great. Karen, thank you so much for your question on Social Security. And if you have a follow-up question, please go ahead and submit that. And Dave, again, thank you so much for jumping on and doing this, but not only doing this, but taking questions as they come in live. I know it's always a trick to go through and be able to do this, but I wanted to ask you, tell me why. We talk about this all the time, but I want people who are here new for the first time or on replay to know why you do this, because it's not like, hey, we set this up just so, we can just make and put a spotlight on you. We're really saying, Dave, why do you talk about retirement and so passionate about it?
Yeah, I'm so passionate about it because I realize people are just not prepared for it. And they've got a lot of misinformation out there. Unfortunately, people have, when it comes to retirement, what we find is that number of reasons that things happen the way that they do. But one, we're not prepared. But two, there's a lot of people that realize it's an opportunity for them to make substantial money off of people because one, the people may be scared that they're not where they should be. And so they're more vulnerable. Or number two, they realize that they've got to catch up. And so greed and things like that catch in. So my goal is just to educate people to say, look, let me be a voice of reason behind what's going on out there. Let you get the education and the information you need so that you can make the right decision so you can have a retirement that looks like in your mind. Now, many people have a vision of what retirement is going to look like, but unfortunately, too many people get to retirement and that vision doesn't match up at all with reality.
And I'm so glad that you do this and talk about it because, again, we got to work together and spend a lot of time discussing this on the back end. And I really appreciate how authentic you are with this because it really does help people to get the right advice and not just the advice that somebody's given them and says, you have to do this. And again, you even talked about communication earlier, making sure as a couple that you're working through this together and not just saying, I'll go make the decision for you, kind of hang out and let's see what happens. So I really appreciate that.
Well, and part of the problem is, CR, is what we find is that many people will spend way more time planning their next vacation than they ever will spend planning their retirement, especially things like Social Security. They're going to spend way more time trying to figure out where we're going to go on vacation, what flights we're going to take, where we're going to stay, what excursions we might do while we're there. And they're not spending the time taking care of what's important. And then it comes to a point that they have to. I mean, there's a point in all of our lives that we can't put it off any longer. We're either at retirement or we're so close to it, we've got to make those decisions. That's my goal, to help people get information as early as possible. Now, if you're someone that's waited, hey, hopefully we can help you understand how to eliminate the risks so that you can have a better retirement with the assets and the income that you have.
Yeah, exactly. Well, Dave, I wanted to jump back on Medicare here and ask read Susan's question that she asked. Are Medicare late enrollment penalties for just 1 year or for the rest of your life?
Susan, these are for the rest of your life. And many people ask, well, why in the world would the government do that? Why do they penalize you for not taking a benefit that they're offering? Because your Part B premiums, remember, you're having to pay a portion of that. You have an amount that you've got to pay on a monthly basis. And Medicare is structured like every other insurance program out there. The healthy people pay for the unhealthy people. So what they don't want to do is have you say, look, I'm 65, I'm very healthy, I don't have any issues, I won't pay my premiums, I won't sign up. But then you hit age 70 and you start having those medical issues. Okay, now I'm going to sign up for Medicare and pay the same price I would have back when I was 65. That's what they're trying to prevent. And that's why they put the penalty in here to incent those people to take the benefits, even if they don't have medical issues at the time, so that they can use those funds to help cover those who are having major medical issues already.
And let me ask another question that's very similar, but if I'm ready to take Medicare, how soon can I apply for it?
Yeah, what you want to do is apply 3 months before your birth month. So if your birth month's October, which is like mine, where we have the same birth month, 1 day off and many years off, you're much younger than I am. But if your birth month's October, then you're going to want to go back to July. So in July, you can apply. You want to apply as early as you can so you don't miss that enrollment period, because if you miss that enrollment period that you have, you're going to be subject not only to the penalty, but you may have delayed coverage. Another big issue that all of a sudden you've missed a gap in coverage, you end up with a major medical issue, having to pay for that out of pocket. It's going to be a nightmare.
Yeah, exactly. Dave, I've also got one of my friends jumping on from Puerto Rico to say hi. So it looks like we get people from all over the place for you.
Oh, yes. Welcome, Puerto Rico. Hello.
Yeah, it's great. I love to have so many people on joining, because it's amazing that we get all these people live to come on and be part of our chat here. And I really appreciate you being here, and again, for asking your retirement questions, because we're always here to help answer those questions for you. Dave, my next one's from Michael, and he says, if you turn 65 in 2020, what year's income is used to determine your Medicare premium?
Yeah, this is an eye-opener for many people. So what he's talking about is if you make too much income, your Medicare premiums are going to be higher than what you would normally pay. They're going to increase based upon certain levels. The first cutoff, I think, is about $170,000 of income for a married couple that you're going to have. What they assume is that it's going to be based upon the year that you're paying those premiums, but it's not. It's 2 years before that. So if I'm talking 2020, they're going to look back at my 2018 tax return, figure out what the income was that they're using to determine for Medicare purposes and what those premiums should be. And then they're going to send you a bill for the difference. So if you have been paying a lower amount and then all of a sudden it comes up that should be a higher amount, you're going to be stuck paying those additional premiums.
Dave, it seems like we have a lot of people coming up and asking these questions as they're already kind of to retirement, and they're kind of, I don't want to say in panic mode, but they're in this mode where they're making rash decisions and they're not really ready to make a full commitment, or they're just trying to take the first decision that comes to them. How do we help guide them that are already kind of at the doorstep or in the door already, and they just need some help?
Yeah, I think the real thing is opening that line of communication as quickly as we can. We're out here trying to educate you, allow you to get the information. And what you don't want to do is sit in one of my webinars, listen to what I say, and think, okay, well, I can wait 2 more years before I really address these issues in my own life. It's making sure you get those answers as quickly as you can. And one other thing, CR, that I want Michael to be aware of when you're looking at this, and anyone else out there that has increased premiums because they made too much money for the Medicare, there are options to get that reversed. Like if you end up losing your job, if there was a divorce or separation in the family, maybe someone died, there are options to get that reversed. But be aware that a Roth conversion is not one of those. I get asked that all the time because many people are doing Roth conversions, and I'm all for that right now. But if the advisor isn't doing their job, they may not take into consideration that those Medicare premiums are going to go up. And so it may be a surprise to you when all of a sudden the conversion's done. You're like, oh, wait a second, 2 years later, my premiums just went through the roof. The other one is if you get an inheritance. So if someone gives you a large sum of money. So what the government's trying to do is say, look, if you had economic circumstances beyond your control that's putting you in a bad financial situation, such as a divorce, death, or loss of job, we'll allow you to pay less money. But if it's just because you're trying to save taxes in the future or you inherited a bunch of money, not an option to get out of it.
Awesome. Well, Dave, I'm just going to try to squeak in one more question before we go. And that one's from Karen. And Karen says, is there a Medicare Advantage plan that covers the whole U.S.?
That is a great question. And today's answer is no. The January 1st answer is yes. So as I understand it, that United Healthcare is going to have a nationwide plan starting January 1st, 2021. Most Medicare Advantage plans are geographically located because they're contracting with doctors in a geographical area, hospitals. So maybe like myself, I live in Tennessee, CR, you live in Utah. We're generally not going to be able to have this, and historically wouldn't have the same Medicare Advantage plan because of our geographic locations. And one of the reasons many people won't sign up for Medicare Advantage plans because they realize that if they leave the geographical area, they're not going to be covered. But now, as I understand it, the United Healthcare is launching a nationwide plan because of their size. They're the second largest insurer behind Medicare. Medicare is the actual largest insurance company in the country. The United's right behind it, and they'll be launching a nationwide plan. But something you definitely want to look at if you are looking at Medicare Advantage plans, you do have to consider geographic locations.
Well, Dave, I know we're here on our 30-minute time, and I just wanted to kind of put a little plug in here and let people know that tomorrow's a very special day for you. It's not a birthday, but I know we have something that has to do with your webinars tomorrow. Can you explain that?
Yes, tomorrow is going to be a special day for us. It is going to be a day where we're finally hitting our 100th webinar. So it's our opportunity to get to a point that we have, gotten ourselves to 100 shows. Hard to believe that we've gotten there.
And I'm so excited, Dave. So again, those who are watching right now, if you just want to get more information, you want to learn more, you can go to theprosperityguy.com and you can click on the events and you can see all the webinars. And like Dave said, he's got his 100th webinar, which is very cool. He's been doing this about a year now, but really only about 6 or 7 months full-fledged into this, right?
Yeah, we did probably, I don't know, 5 or 10 webinars is all up until April of 2020. And then from there, it's been nonstop. And it's just getting crazier. I mean, we're currently adding 4 new shows. We talked about this earlier today. We've talked on previous shows or podcasts where we're launching 2 new webinars. Well, I just got asked to launch a new one. It's going to be talking about the potential changes or the changes that are being promoted with Joe Biden, if he under his presidency, what that would look like and how it would affect your retirement. And we're also putting in a question and answer show, just answering Medicare, Social Security, and reverse mortgage questions. We have such an interest. Every time I teach those webinars, it's not uncommon to have at least 100 questions at the end. So, hey, let's just put together a webinar that all it is answering people's questions, very similar to what we're doing here.
Well, Dave, I can't wait. I'm very, very excited. And I want to put one more plug in for your podcast. You have your podcast that comes a new episode every Friday. And it's awesome because you really address everything from Social Security to reverse mortgages to Medicare to long-term care. You just really dive in, and it's so refreshing to have something like this in there for us.
Yeah, it's a great opportunity to be able to just share more information. I mean, that's what I'm here for. I realize in a webinar format, one, that everyone doesn't consume information in that format, that maybe you want something in a shorter period of time, which our webinars or our podcasts are. They're anywhere from probably 20 to 35 minutes on average versus an hour. But I also realize that I can't cover all of the information that people need in a webinar format. That it's just too hard to be able to put those together on a consistent basis and to be able to put that much content where I can take 15, 20 minutes to put a show together. We add some questions and answers on the back end of that, and we've got an opportunity for people to really educate themselves.
And again, if you want to even get more information, you can go to theprosperityguy.com and click on the blog, and you can read about any of the details that were part of the podcast. And all those are broken down. And so, Dave, you've actually gone through 30 episodes of season 2, and you're on your 100th webinar, and you're adding 4 new webinars. I mean, what's next? It just seems like you're continually growing.
Yeah, I hope there's a day that we can get back to real in-person live events. That's one of my biggest goals, is that we can get back to where we can have a prosperity summit where we can just get people together and really connect. One of the hardest things about what I do is I don't get to see everyone on the other end. People get to see me, they get to see you on these platforms, but I don't get to connect with them like I'd like to. And I've spent most of my career connecting with people. Face-to-face meetings. That's the way I love to do it, is I want to be able to look people in the eye and shake hands, hugs, whatever it may be, and just get to know people. And it's been hard not to be able to do that. So I hope we're back to a point at some point here soon that we can really start individually connecting with those who we share information for, and those who support us and want to really help their retirement to get to the point they can be tax and risk-free.
And again, Dave, thank you so much for being here today, for answering the questions we throw out, and again, for those live questions that came in. And again, if you have additional questions, please go ahead and submit those at theprosperityguy.com. There's a contact place where you can go ahead and submit your question. We'll get those answered on another live show, or you can just join us next time. And so we're again on Facebook and YouTube live right now. It's important that you're here with us live so you can ask these questions. And again, the best part about it is you also can ask a follow-up question. So we want to make sure that we're here to take care of you and educate you so you can get to a safe and risk-free retirement. So again, Dave, any final words as we sign off from live today?
So only final words is please keep coming back. I love doing this. I want to make sure your questions get answered, and don't be afraid to ask those questions. If you're out there and you're listening to the show, you're participating in the show, don't be afraid to put your question out there. We've seen thousands of them at this point. Sure, now at this point, we did a count at one point. We had over 2,700. I'm sure by this point, we've got to be over 4,000 when you consider the number of shows we've done since that time. But we've seen them all. And I can't answer every question. I will tell you, I do a pretty good job when you consider the breadth of knowledge that I have to consume to be able to answer these questions, but I can't answer everything. I am not a guy that knows everything in this world, but I am also willing to share my opinions at times too, to let you know what I'm thinking.
Yeah, that's awesome. And before we sign off, Dave, I just want to read Karen's thanks. She says, thank you both. I love these webinars. I learn so much every time, on congrats on 100 webinars. Very cool. And we're just so excited.
Yeah, thank you very much, Karen. We appreciate your support and look forward to being able to help you in any way we possibly can.
And again, for all of those who are joining us live, thank you so much. And on the replay, thank you for being here and supporting the show. And we'd love to see you on another event through either a webinar or a podcast. Even jump on and read the blog. There's so much information out there, and we hope to just help you get to a tax-free and risk-free retirement. And again, Dave, thank you so much for joining us live today.
You're welcome.
See you guys.